Okay, let's jump right into this explainer. Today, we are unpacking a massive, honestly mind-boggling paradox, how a wave of absolute euphoric gold buying suddenly flipped into a historic market crash. I mean, earlier this year, it felt like the entire world was obsessed with chasing exactly two things, gold and silver. But as we're going to see, the retail market completely misread the room, and that led to a pretty spectacular collapse in demand.
To really grasp the scale of this whiplash, picture the scene at Mumbai's Zaveri Bazaar during Dhanteras last year. Thousands of people lined up for hours, just desperate to buy gold and silver at all-time highs. You might even remember that viral video of a foreigner standing there in absolute disbelief at the sheer volume of the buying frenzy. But then, almost immediately after that peak euphoria, a massive panic-selling spree kicked off.
And when I say panic selling, I mean the numbers are staggering. Between April, May, and June, literally just 3 months, Indian retail investors liquidated about 50 tons of physical gold. The exact same people who were dead set convinced that gold was on a non-stop rocket ship to record heights? Yeah, they suddenly found themselves dumping their assets at a blistering pace.
Now, to put a 50-ton sell-off into perspective, that calculates out to roughly 75,000 crores. Think about it like this. If you took that money and distributed it, it's enough cash to buy every single person in India about 53 Britannia Marie gold biscuits. That is a colossal, almost unbelievable amount of wealth just reversing course in a single quarter. So, what exactly went wrong?
Well, let's get into Section 1, the hidden driver, geopolitics and history.
To figure out why this crash happened, we have to look past the retail market entirely and examine the macroeconomic history of the US dollar. You simply can't understand gold without understanding geopolitics. They are permanently linked. It all really starts back in 1944 with the Bretton Woods Agreement, where 44 countries agreed to trade in US dollars, and the dollar itself was officially pegged to physical gold. It was a masterstroke, right? It made the dollar the global reserve currency. But by 1971, the US just couldn't keep up with global demand for gold redemptions, so President Nixon permanently severed that connection. From then on, the entire global financial system was based purely on trust, and what's wild to uncover is how that foundational trust was shattered in 2022.
What's super fascinating here is that this exact scenario was predicted decades ago. A Belgian-American economist named Robert Triffin warned of something called the Triffin dilemma. Basically, he argued that as the world economy grew, global demand for dollars would skyrocket and eventually outpace the actual gold America kept in its vaults. And history proved him absolutely right. By the late 60s, countries like France panicked. French President Charles de Gaulle literally demanded their 3,300 tons of gold back, and they organized 44 ship trips and 129 flights just to retrieve it. This deep-seated historical fear of relying too heavily on one nation's currency, that sets the perfect stage for our modern crisis.
So the crucial takeaway here is that the real catalyst for this recent gold boom wasn't retail demand at all. Not even close. It was a geopolitical earthquake in 2022. When the Russia-Ukraine war kicked off, the US and Europe froze roughly $300 billion of Russia's foreign reserves. Overnight, the trust holding the global monetary system together basically vanished. Central banks everywhere watched the dollar get weaponized, and they collectively panicked, realizing, hey, if it can happen to Russia, it can happen to anyone.
Naturally, their immediate reaction was to seek safety. Look at the sheer volume of gold these central banks hoarded to diversify away from the dollar. China bought 350 tons, Poland bought 320 tons, Turkey grabbed 220 tons, and India bought roughly 130 tons. We're looking at a massive, highly coordinated pivot by the most powerful financial institutions on the planet.
And because of this aggressive buying spree, the global landscape of reserve assets completely transformed. I mean, in just 3 short years, gold leaped from making up 16% of global reserves to a staggering 27%. It actually overtook the US dollar to become the #1 individual reserve asset held by central banks globally. That is a game changer. Which brings us to Section 2, the retail illusion.
Now, here is where the story takes a pretty tragic turn for everyday investors as we zoom into the micro perspective. While central banks were buying gold purely to protect their national reserves with a very long-term structural approach, everyday retail investors completely misinterpreted this shift. They saw the institutional buying, they watched prices climbing, and they mistakenly assumed prices would just artificially double or triple overnight. They saw the momentum and completely gave in to FOMO.
Caught up in absolute euphoria, retail buyers just poured blind money into the market.
In January alone, over 24,000 crores flowed into gold ETFs, and those inflows were growing at 100% month over month. People were literally liquidating their mutual funds and stock portfolios just to chase gold right as it crossed the 1.8 lakh rupee mark. It was pure speculation. They were completely ignoring the golden rule. Buying any asset at an all-time high is incredibly risky.
All right, moving to Section 3, the oil and dollar twist.
So, this massive retail illusion gets suddenly shattered by a geopolitical plot twist in the Middle East that completely derailed the gold rally. Amidst rising tensions and a U.S. attack on Iran, something highly abnormal happened. Iran closed the Strait of Hormuz. Boom! This instantly triggered a massive spike in global crude oil prices. Now, normally in times of war, gold prices go up, right? But this time, they started dropping. Why? Because this specific event created a sudden, desperate demand for the U.S. dollar.
It all comes down to the mechanics of the petrodollar. Global oil trades almost exclusively in U.S. dollars. So, skyrocketing crude prices forced import-dependent countries to hoard dollars just to pay their massive energy bills. The exact same central banks that were aggressively buying gold just months prior had to abruptly pivot right back to the dollar just to survive the oil shock. The economic reality hit hard, and it hit fast. Asian currencies, including those in India and Indonesia, began dropping rapidly. Trade deficits soared. It got so bad that Turkey was actually forced to sell off the gold it had just acquired just to stabilize its economy. With that, the massive central bank gold rally that was propping up the whole market completely stalled out.
And finally, Section 4, the contrarian investor.
With the big institutional buyers suddenly gone, the tide rolled out. That left retail investors in a total panic, triggering those massive ETF liquidations and that 50-ton sell-off we talked about at the start. So what's the actual lesson from this spectacular boom and bust? We really need to return to ancestral wisdom. Historically, gold was never a get-rich-quick trading mechanism. It's always been a very long-term asset meant for generational wealth and extreme emergencies. When you buy it for short-term speculation, you're totally stepping away from its fundamental purpose.
To survive markets like this, you've got to adopt a contrarian mindset. As Warren Buffett famously says, you need to be fearful when others are greedy, and be greedy when others are fearful. When thousands of people are lining up outside Zaveri Bazaar to buy at all-time highs, that is exactly when you should be stepping back. When the herd is liquidating and no one wants to even talk about gold, that is when the real opportunity exists.
As we wrap up this explainer, I really want you to leave with this thought. Look at your own portfolio and ask yourself, are you buying assets to build generational wealth and true security, or are you just blindly following the herd into the next trap? You've got to understand the macro picture, resist the hype, and always invest with a clear long-term purpose. Thanks for joining me for this one.